Hello, my Teaserking family. How is everybody today? Looks like I do have sound. I don't know why sometimes I don't, but I have it. So today I'll start with economics and then I'll do a football one. I mean, there's only 4 games. So I don't need the long length of time that I normally when it's all the college games and all the pro games. So we will talk about that this afternoon. So I'm looking through all my notes and through all on what's going on YouTube and everything. So I basically want to explain things to make it easier for everybody to understand. And so that's kind of why I'm doing this. And I'm doing this. I talk about it anyway. Most of my videos are like 3 hours, and I do talk about it. But in this situation, I can just get to the meat. What is inflation? What is paper gold? And then you can quickly find it and know what it is. I had a video blocked yesterday, but I unblocked it when I showed that queen, the crypto queen. Apparently, that video didn't allow me to show it. Like it was, what did they call it? I didn't have the right to show it or get the rights. So I get an email that says you're blocked, and then it says, but here's why you're blocked. And then it's usually a video because I show the videos, and then they'll say, oh, okay, you're blocked, but here you go anyway. Just delete that part of it was like a minute of where I was showing what she was doing. And when I did that, then everything was fine. So I deleted it, and I see the video out there. So it was a very good one. I must, all of mine are. So today we're going to talk about the trade cycle, the medium of exchange. What is it? Just a brief. And how do you want to be a financial power? And what's wrong with the U.S.? So let's start with that. So how do you become a financial power? So you're a government, you're a country, you want to be a financial power. How do you do it? Well, the first thing you need is low taxes. Second thing you need is free trade, most importantly. You can't charge tariffs for trade. It's I have the Mahomes card. You want it? It's free trade. Okay, you want to give me $100 for it? It's yours. There's no tariff to it. What a tariff is, I want to sell it to China, and then it's $100 plus $20 for the tariff, the tax. That's what it's saying. It should be free trade. You need a rule of law that people actually go by. It's not corrupt. It actually has to, and it protects the consumers and the producers. So you can't have monopolies. You can't have JP Morgan's cheating everybody and all this disgusting stuff that they do, or Wall Street or the banks. Stable money. So it should be backed by gold. You should have a gold-backed currency and good communications. So these are the 5 things if you want to become a financial power. So again, most important, very little taxes, free trade, a very good rule of law that is obeyed and done. And then, of course, the stable money. We'll look at the U.S. now. We don't have low taxes. We don't have free trade. We don't have a rule of law because everybody is corrupt. And the stable money is out the window. It's printed to zero. So this is why the U.S. is collapsing. So if the professor wants to take his gold and buy a country, and we'll be able to buy them cheap, that's what I would have in my country, and we would be very successful. This is what every good country, Roman, and what we used to be like here. This is how you are. You don't want high taxes. Taxes are bullshit because you don't want a big government. You want the government out of the way. I can deal with you guys. I can sell my card, and we have a rule of law that if I cheat you, you're going to, hurt me in the law, and the money's stable. So I know $100 is $100. and in good communication. So I don't lie. I tell you what's reality, and that's how you become a financial power. But yet, the biggest problem right now is there's no rule of law and there's no stable money. All the money is printed to zero. It's all inflated. So of the five things you need, they're killing the taxes, they're killing the law, and they're killing the money. As far as the free trade, I'm not sure. I don't think it's free trade. That's what caused the 1929 crash. Was they did tariffs. So on the trade that should be free, they're charging this tax on the tariffs. You can't do that. So that's the difference. That's what a good country should be, those five things. All right. So now let's get to, where was that? The medium of exchange, which I think is right here. Oh, no, I think it's in here. Damn it, I just had it. I apologize. All right, excuse me. On another sheet. Okay, so let's talk medium of exchange. And then we will talk the trade cycle. Okay. Okay, so medium of exchange, what's that? Do you hear that? Do they even use it? It's what everybody wants. It's the money, it's what you use to get paid and buy and sell goods and services. So you want to buy a banana, what do you use? You use something that's, and here's the characteristics. Originally, cows were the medium of exchange. Imagine that. There's two values to it. It's exchange and its use. So you exchange it for goods and services and how you use it. Convenience develops by economics. So it's something convenient, right? So the qualities of the medium of exchange is it must be portable. A little bit does a lot of work. So this is portable. You put it in your pocket, or now it's even more portable. It's a debit or credit card, but it still goes back to your bank account where the money is. It's got to be scarce, not printed to zero like these idiots are doing. So it must have a high value, which is why gold is usually the medium of exchange, because it has a high value and it is scarce. Overabundance loses value. What do we got going on? The inflation, they're printing the money. It's overabundant. It has no value. It's divisible for small exchanges. Okay, you can see this is a 5 and I got a 1. So you can use it for small exchanges, or there's $100 bills. Fungible, everything is the same. Well, money is money. It's just a different, but yes, this is all the euros are the same paper, just with different numbers on it. And it's replaceable. Yeah, you spend it, you can get more for it. Acceptance. So everybody must agree that this is a medium of exchange. So if I take this to a store or a restaurant, they will accept it in lieu of what's going on. So they accept. Will they accept the money? Yes. And if it's on a debit or credit card, will they accept it? Yes. So this is what This is exactly what they're looking for, is to have something that's acceptable. Is Bitcoin acceptable? No. A lot of people don't take Bitcoin, so it's not acceptable. So therefore, it can't be money, because acceptable means I can go to grocery store and buy, or the restaurant or the store, and they take it. Durable. Gold, we know, is durable. Can't do anything to gold. Paper's pretty durable. The debit and credit card are very durable because you're using those for the exchanges. Value is the most marketable commodity. So this is the problem with the digital currencies. They're not acceptable. And after what's happening with the queen of crypto, with the OneCoin and the Bankman and Neinhart guy and all these other guys, you can see nobody trusts it, right? You don't. Are you going to really trust it and then wonder, well, wait a minute, I had Bitcoin. Oh, wait, it's gone. So I'm going to trust that? I don't think so. So that's what really happens is it's got to be credible and trustable, right? Again, that goes to the acceptance. Do I want to accept this digital currency, or have the crypto queen steal it from me? Again, I'm not taking possession. That's why I don't see how you could ever have a dollarless society, nor would I understand why you would want a dollarless society. Now, as long as it's in the bank and I can get it, there should be dollars. Even though I use my debit and credit card, that's fine. But I shouldn't be, if I can't at least touch it, like the Mahomes card. If you're selling me a digital Mahomes card and I can't touch it and put it in my safe, if I can't do that, I don't really. To me, I don't have anything. Much like an ETF. I think stocks are different because you open up a E-Trade account and you buy 100 shares of Coke. You can see you have the 100 shares of Coke. I think that's a little bit because you can sell it, right? I want to sell the 100. It's not a problem. It goes right through. There's a money maker. But can they take it from me? Sure. They can say, sorry, you don't have the 100 shares anymore. But they can't take this from me. It's in my hands. Now they can tell me it's worthless, which is what Attack on Wall Street was about. The guy had 60 grand, and next thing knows, no, you don't. It's worthless. Just people aren't paying their mortgages, so we're not going to give you the money they were giving us. We were giving you, and since they're not giving us money, we're not giving you money. So that's the danger of things that you can't hold in your hand. So they're pretty safe, the real estate trust and the stocks and the treasury bonds are pretty safe, but not, you could get a zero on them, right? Oh, the market just crashed. Oops. See, let's say you own 100 shares of Coke now and the market's crashing, and now you have 100 shares, but you know what? It went from $70 a share to $5 a share. And that's really the problem with these things, is that you can't control. You can buy them and you can sell them, but you can't control waking up and the $70 share price is now $5. You can't control that. And that's the problem. So that's what you got into with not actually having it, right? It's got to be in your hand. So you trust it more. Gold, you trust in your hand more than you trust an ETF and everything. All right, so that's medium of exchange. It's basically, it used to be tulips in Amsterdam, and it was gold and silver coins in Rome, and it was France and Spain and England had gold, and they had gold-backed currency, and they were the leading countries. They all had that, but that's no longer the case. And so you just got to be careful of all the digital stuff. It sounds good. I'm going to be rich. I mean, that's what they sell you on it, right? You're going to be rich. I mean, Bitcoin, what they sell you on is, well, we don't want to be controlled by the government. We got to get out of the government. There's no other place to go. Well, yeah, gold and silver. Okay, gold and silver are manipulated, but there's still, if you buy them, that's you're out of the government fiat currency that they're printing to death, that they're not following their own game plan of the medium of exchange. And that's the problem. They're supposed to be limited. They're not. They have control over the printing press, and they print and print and print. And that's really the problem. So you're sitting in there trusting that the dollar has a value, and you're trusting the government. Two things you shouldn't do. Government caused the 1929 crash. They caused the Great Depression. They caused all the wars. The massive inflation in the 80s was caused because we got off the gold standard. And they're printing and printing and printing to pay for all these wars that are just a waste of time. Why is there a war? What is the point of that? We're going to fight you. Why? Why are we fighting anybody? It's the stupidest thing in the world. So I don't really get it. But let Biden fight the Russian. Let him fight Putin. 1-on-1. That's our war. Okay, the U.S. against Russia. There you go. And that's what you really. Why is there a whole army? Now you got to pay for the army. You got to pay for the weapons. You got to pay for the food and the clothes, the gas and everything to get them there, all the bullets and rockets. And, so war is very expensive. So it's crazy. All right. So let's get to where Austrian theory of the trade cycle. Fiduciary credit inflation generates the trade cycle, which is the banks printing money. This is the deadliest thing. This can only happen if the banks print money. The trade cycle, hence the inflation, will not happen if it's created by an increase in savings. So if it's just savings and the economy, and you're doing things and there's demand and you raise prices and everybody wants it, it's okay. Only by an increase in the money supply. So the trade cycle will only happen if there's inflation or an increase in the money supply. It's the only way it can happen. But it happens all the time. So here is the trade cycle. And there's approximately 16 steps to the trade cycle. And it's mostly related to the interest rates, and it's by the Fed. So number one is the decision. I'm not going to get too much into it right now. I'll keep the overview of it. One is the decision by the Fed to lower interest rates. So we're going to lower interest rates. Why? Not because of the market. We're going to lower that. We want to increase the economy, but we're going to force it. We're going to lower interest rates to make things cheaper. It changes business decisions. You buy equipment, you buy real estate. Interest rates are a big decision on whether to buy a new product. If interest rates are low, you buy. If they're high, you don't. The savings goes up, the interest rate goes down, investment goes up. I don't want to get into that. So savings drop when interest rates go up. If investment goes down, that doesn't make sense. Savings plus money supply is LF. Savings get increased through taxes. Money supply increases. I'm going to let that alone. So basically, if interest rates are a big decision on whether you buy new. So if things are cheaper, you buy. If things are more expensive, you don't. Interest rates or the cost of money. Two, increase in the money supply, fiduciary credit inflation. Inflation goes up, money supply goes up. Where money is spent gains, the A people and D people get hurt, the people on a fixed income. So if you're getting Social Security and that's it, you're hurt because you're getting a fixed amount, but the value of the dollars are dropping. So you're actually it's not worth the same amount. So one, the Fed lowers interest rates. Two, they start printing and increase the money supply, which is the inflation. Three, capital gains. Boom always starts here due to demand, capital machinery, boom. Trade-off between wage rates and interest rates. So as you're making money cheaper and interest rates less, you'll buy more capital goods. So GM or Ford will go and buy more equipment and machinery and tooling because it's cheaper, right? You've lowered the rates, you've lowered it, the money's easier, it's 0%. So you borrow it. I'm going to put in a new tool and capital. I'm going to spend on capital goods. Number 4. And there's a stock market boom that happens at this point. So people are putting their money into stocks. 4, prices go up due to demand and money supply goes up. So you start raising prices because people want to buy things. All of a sudden, I have more money. I'm going to buy this and this and this. So they raise prices due to demand, not due to inflation. But the money supply is going up because they're printing money. 5, the Fed increases the money supply to keep the interest rate low. So they keep printing and they're keeping the interest rate very low. 6, malinvestments start happening. People invest in things they shouldn't because the interest rates are zero and the money is cheap. So they'll buy this and they'll buy that because it's cheap. Overbuilding, over mechanization, too much capital. Begin projects based on low interest rates and too much capital. The key, the trade cycle bust at malinvestment stage. No demand, too much supply. So it's like electric cars. There's no demand for it. You're making them, and that's when it busts. Banks must fold. Companies can't pay back IOU. Nobody thinks the boom will end. That's the problem. So the interest rates are zero, and they're printing money, and you take out a loan, and it's zero, and everything's great, but you don't know what you're doing. You're just spending to spend. You're running a company, and then you don't think it'll end because it's not based on supply and demand. It's not based on I came out with a new computer and everybody's going to buy it. Well, eventually it'll saturate and competition will come in, and that'll be the end of it, but you don't see that. 7, the boom continues based on low interest rates and lots of capital. 8, consumers get increased income. Consumer goods boom. So the consumer goods go up, the consumer income goes up. The debt bonds based on assumption of increased income. Consumer goes into debt because they're making money and things are cheap. And so they're buying hand over fist. Savings drop, debt goes up. Okay, everybody wants consumer goods. And they're doing it on credit because it's cheap. The interest rates are 0% or very little for the consumers. Number 9, economy is less liquid. Consumers are into debt. Banks have the malinvestments. Savings are dropping. So there's problems happening because that it's free money, right? It's low interest rate. They're printing and printing. That's inflation. That's what's happening. It's always happening here. Since they print the money, they just print it and it's available and they use it, but they shouldn't, right? It's spent poorly. Malinvestments are a stupid investment. I think I'll try golf. Yeah, no, I really don't want to. Well, you just spent $1,000 on clubs and shoes. Who cares? 10, cash crunch. Banks start restraining credit due to falling savings and begin to question, can the borrowers pay us back? So the banks start worrying, wait a minute, the economy could be slowing. It's less liquid. We've lent out all this money. But again, as I've stated with banks, if I give a bank $100,000, they're going to give me 3% interest. They got to get the money from somewhere, unless it's a Ponzi scheme. So they need new people to give them money, or they need the people to take out loans with my money, because they don't have my 100 grand sitting in the bank. It's gone. And so they come out with, they're going to come out with new. They've got to get the money to pay my savings, right, or my annuity or money market or whatever I'm in, CD. They need to pay it. So the banks start worrying and restraining credit due to falling savings and begin to question, can the borrowers pay us back? So the people now borrowing money for cars and houses, all of a sudden they're getting laid off. All of a sudden they're worried, can these people pay us back? Because we need that money to pay. But if we got bad loans, we can't pay Howard his interest. 11, the inversion in the yield curve. Short-term rates are higher than the demand, than long-term rates. The demand for short-term rates goes up. Long-term rates stay even. This is a crest for the boom. It's over, and red flag. This is not good for an economy, because theoretically, the longer you wait to get your money back, the more you should get. In other words, if I buy a bond and I give you $10,000, well, at 3 years, it should be 2%, but at 5 years, it should be 5%. Because I'm giving you the money longer, I should get more return for it, for the risk of doing it out longer. And that's what it should be. But wait a minute, and we have this right now. What do you mean there's an inversion in there? So wait a minute, for 2 years you want 5%, for 10 years you want 2%? Well, who in their right mind would do 10 years? You would do 2 years. I get the 5%. Here I'm only going to get 2. I've got the risk, you paying me back, so I'll just go out 2 years. And that's a real, that's a recession 100% of the time. All right, 11. Number 12, the cluster of errors. Banks want their money. Get out of loans and debt, panic selling, abandoned projects. So the banks start freaking out. They go, wait a minute, we're not getting paid back. It's attack on Wall Street time. These guys aren't paying their mortgages. I can't pay attack on Wall Street guy. I'm fucked. So they start realizing, hey, we need our money back, but they can see the defaults happening. They can see people can't pay them back. And so they want to get out of all their loans and debt because they don't think people can pay them back. 13 is the liquidation phase. They sell, cost cutting, companies close, and there's layoffs. And we're kind of in that phase now. You're just getting out of all of the stupid malinvestments that you got in when things were cheap, when interest rates were zero, and you're doing things that you really don't need to do. They're not your business. Maybe you buy an extra house, or you buy a nice car, and then you realize, oh shit, I can't afford them, and then you sell them back. So you're liquidating your bad investments. 14 is deflation. Banks have bad loans. Fiduciary money goes down. Banks can't find willing and able to borrow. So they have money. They got to pay my interest on the CDs. And they got all these bad loans that people can't pay them back. So that's really what deflation is, not prices going down. The Keynesians like to use they're living in their own world that doesn't make any sense. Step 15, banks can't find borrowers able and willing. So the banks want to loan the money out to good people. That's why I get calls. I have good credit, so they want to loan me money. And then they go, they can't find me, or I don't want the money. I don't want to borrow. I don't want to go into debt. 16, and final stage, cleaning out process. Everybody tries to get liquid. Businesses lay off. So we're close to this now. There's a lot of layoffs happening. We are deeply in a recession, but they won't tell you that because then you won't elect them, because your elected officials can never have a recession or inflation, or the economy can't be going well. So they pump money into the stock market, say, look, inflation's 3%. Bullshit. So that's what it is. The trade cycle will not happen if it's created by an increase in savings or the economy is doing well. You won't have a trade cycle. Only by an increase in the money supply, which is inflation. So again, the government fucks around, gets in the way, and creates this vicious trade cycle where it kind of scams you into, look at the rates are low, you can borrow money. Oh, now you got to pay it back. And that's the end of it. So let's go back to step one and just at a very high level. So the beginning of the trade cycle, the decision by the Fed to lower interest rates to stimulate the economy. Instead of just letting the economy do its thing, right? Get out of the way, stop taxing us. Don't do free trade. Just let it go, and the economy will be fine. It fixes itself in Austrian economics. So they go in and they lower interest rates. What the fuck are they doing? It increases the money supply, fiduciary credit inflation. So they're printing money to stimulate the economy. This is what Keynes does. 3, capital goods boom. Always start here. So, so you're getting cheap money in, and you go buy machinery and equipment. Mostly this is going to be GM and Ford, right? They start buying tooling and capital and goods and plants because, hey, we got all this extra money at 0%. We might as well spend it. No, this is what causes the problems. 4, prices go up due to demand, due to the money supply. 5, the Fed then increases the money supply to keep the interest rates low. So they want to keep that 0%. They want to keep the economy growing so they can say, look at us, we got the economy growing, keep us in office, even though you're fucking everybody over. 6, male investment. People invest in things they shouldn't. So because the money's free and the interest rates are low, you start spending, like I said, on golf clubs or a Ferrari, things that you would never do. But because it's cheap, you do these things. But they're not needed. They're just wants, not needs. 7, the boom continues based on low interest rates and lots of capital. 8, consumers get increased income. Consumer goods boom. The consumer gets goods go up. The consumer income goes up. So you're borrowing money at 0%. So you go on a trip, you buy a car, you buy golf clubs, and that creates this boom in the consumer. So the other one was capital goods go up. Now consumers. So you go on a vacation, maybe you buy a house, or maybe you fix your house up or put a deck on it or something. 9, the economy is less wicked. Consumers are into debt because they can't afford anything. So if they put a deck up, they might charge it. They go on a trip. They do a lot of what they do, and they put it on their credit card. So now you've got money out of the economy, and the consumers are in debt. 10, the cash crunch. Banks start restraining credit due to the falling savings and begin to question, can the borrowers pay us back? So the banks start going, I think we fucked up here. We might have given money to people that can't pay us back. We're not really sure. 11, inversion in the yield curve. Short-term rates are higher than long-term rates, which makes no sense. There's no faith in the long term. Why is the 2-year 5% and the 5-year 0% or 2%? And that shows you there's a recession, depression coming. And that's what we have now. 12, the cluster of errors. The banks want their money back. They realize they shouldn't have lent out money to people that maybe can't afford it, although they should be looking at credit scores. 13 is the liquidation phase. sell, cost cutting, companies close, layoffs. So they're liquidating everything to get their money out. 14 is deflation. Banks have bad loans, fiduciary money. So the banks realize people aren't going to pay them back. So they're worried about it. And now they see it. They're not going to pay us back. That's what deflation is. And the fiduciary money drops. 15, banks can't find borrowers. Again, I got 10 grand in there. You've got to pay me my interest or my money market or my real estate trust, whatever I got, you got to pay me. So the way the banks pay is to lend the money out. They get 5% and they give you 3%. So they make 2% because you have your money in the bank that they can lend out to people to buy houses and cars or whatever else. But they can't find any borrowers. So how are they going to pay me? 16, the cleaning out process, everybody tries to get liquid. So nobody wants to be in debt. The banks need their money. And that's your trade cycle. And it will only happen by an increase in the money supply. So the motherfuckers are inflating the money supply, causing this trade cycle. And that's the Austrian version of it. I know I hear some of these guys on YouTube and they're clueless. Fiduciary credit inflation is the trade cycle. And it's because you're inflating money and you're lowering interest rates instead of the market doing it. See, what I talk about a lot is the market. And that's really the point of it. The market should control everything. That's Austrian economics. And that's based on you open up a restaurant and you sell ribs. Does the market take it? If I have this and I'm going to sell this for $50, does the market accept it? So the key to like economics is the market. And you let the market run itself, hands off, laissez-faire, and it works as long as you have the 5 things I mentioned earlier, which are, I can't find it, my medium of exchange, the other thing. As long as you have the 5 things, where did that go? Thought I was done with it. Anyway, as long as you have good laws and a low government and free trade and sound money and good communication, as long as you have those 5 things, you as long as you have those and you let the market run, you're fine. What is that? That's how it should be, right? The medium of exchange, those are the properties you need, and to have a good government, that's what you need. So you have free trade, you have good laws, you have good money, and you let the market run. Somebody wants computers, then somebody sells them. Competition comes in because you don't want a monopoly. The monopoly helps the producer, but hurts the economy because then you don't allow the competition. So if I want to sell computers, I can't because it's a monopoly. And then, well, wait, I want to sell them. And then it hurts the consumer because he wants to buy the computer and he can buy it cheaper if there's competition. So you let the market run on its own. If you have gold, you don't need interest rates. You only need interest rates with money. But the interest rate should be based on the market, not on the government. The government can't be a central planner. That's communism, and we see how well that works. Every currency under communism, socialism goes to zero because you can't plan the economy for the people. The people are the ones who make the decisions. I want to buy a blue shirt. You can't tell me to buy a blue shirt. It's based on me determining to buy a blue shirt. If I want to buy a Mahomes card, if I want to buy a Mickey Mantle card, if I want to buy gold and silver, if I want to buy stock, That's all up to me. You provide the instruments out there that are demanded. Is there a demand for stock? Yes. Okay. Is there a demand for baseball cards and gold and Canadian Club? If there are, fine. If there's a buyer and a seller, that's a market, and you get the hell out of it. You allow free trade, you don't have tariffs, then everything's fine. Then you just let the market go, and the market will grow and grow, and then new products enter it. The Keynesians don't believe that. They think there is no more new products. I don't know where they get this from, but there was a note I was reading about Keynes, and it was like he thinks, or the whole communist thinks that there's no more, that the economy's it. It's a black box. There's only so much you can make. I don't know where they got this incredibly stupid thing from, but that's what they think. Anyway, so I got a bunch to go through, but I'm not going to. I just want to focus on the trade cycle now and what you need to be a power. So the financial power, we talked about the medium of exchange. We talked about that sound money. It's got to be acceptable. That's why these digital currencies are not money. And you don't really want fiat currency because they're not limited. The currency must be limited to keep its value. The money must have the same value. You can't keep changing the value of your money. And if you keep printing the money, what's it worth? And then, well, wait, $100 isn't worth what it used to be, or $1,000 isn't worth what it used to be. Well, okay, wait, now you're fucked because you're doing something that you shouldn't be doing. You've got the wrong thing out there, and that's really where the problems lie. Is you're changing the value of the money with the inflation. As you print, the more you print, you're changing the value of the dollar. $100 doesn't buy what it used to. And that's so you can have wars, because you need to print a lot of money for wars. Well, wait, if we can't afford the war, why are we having the war? Well, we'll print money. Well, yeah, but that'll ruin the money. And they just don't get it. This is why you should have finance people running your finance and not politicians and lawyers running it. So you got these wars going on, and it's costing a lot of money. And as you're printing the money, you're devaluing the money, so the money's worth less and less and less. So when you get up to $35 trillion debt, when you get that, you got to pay the interest on it. And if you print that money to pay the interest, comes from printing it, comes out of the clear blue sky, the value of it really isn't. So you print $1 trillion, but it's not worth $1 trillion anymore because you printed it and you've added more supply. So it went from 10 trillion to 11 trillion. Oh, wait, no, 11 trillion, if it just comes out of thin air, is not worth what it was. And that's really the biggest thing in the medium of exchange is you've got to have scarce, high value dollars so it's consistent. That's why you go to gold, because you don't need an interest rate and it's always consistent. You can't inflate it or print it. So you dig it out of the ground, so maybe add a little cheer. Okay, not a big deal. It's like 3,000 tons. Okay, oh, that's a lot. Well, not really. Russia will buy the 3,000 tons between all the buyers, the central banks, Russia, China, India, people like me who buy a couple ounces here and there. You end up where that's not inflationary, 3,000 tons. So yes, they do dig. They have more findings, but it's still very, very limited, and it's hugely demanded. So everybody wants it. So for 3,000 tons to come up, it's not hard to put that into the market. But they're not printing trillions of dollars like they're printing in all the dollars, all the fiat currencies throughout the world, China and Russia and the euros and the Swiss and the British and the Middle East, you name it, that's what's printing it. So I noticed the Saudis are and the Russians are like, wait a minute, we want gold for oil because the dollars we're getting aren't worth anything. We know that everybody wants to get out of the US dollar because they're realizing, wait a minute, the value of the dollar is going down. We don't want to be holding to, because what they have to do, because so you're Venezuela now, let's be Argentina. You're Argentina and you want to buy Brazilian dollars. You're going on a vacation and you need Brazilian in Brazil. So you need dollars. So you go buy dollars. So you get 100 Argentina dollars to buy 100 US dollars. That's to say it's even. And then you take the US dollar to buy the Brazil dollar. Well, why do I have this middleman? And that means I got to hold a lot of dollars, right? So from when people want to exchange my money, I got to have dollars for them to get so they can then buy the other currencies. But if the value of the dollar is going down, I got to buy those dollars. So I go and buy $1 million, for example, if I'm Argentina. So I got to buy them like $1 billion. So when people want to change their money, I have it for them because that's the stupid way that it's being done. So if I have to do that, but wait a minute, but I bought it, but now the value of the dollar is dropping. So now I'm holding these dollars that are becoming worth less and less, right? So I paid $1 million for them, but now they're only worth $500,000. And people are starting to get this idea that as I'm holding the dollar, as I need to buy the dollar at this price, the price is going down as they keep printing and printing and printing, and everybody has these dollars becoming worthless. And they're going, well, wait a minute, I'm losing my ass buying all these dollars, so I can buy, why don't I just buy the Brazilian dollar? Now everybody inflates because nobody has gold. And that's the biggest problem, right? So as the dollar's going out, people are going, I don't want to hold dollars anymore. So Putin sees this and BRICS sees that. And what they're going to do is come out with a gold-backed currency and say, look, it's gold. We can't fuck with the gold. So you'll buy gold that'll hold its value versus the dollar that's going to lose its value. And that's really the key to it. So I take my Argentina dollar, I buy gold-backed dollar. So now if I'm the Argentina government and I'm still going to play this stupid game of I got Argentina money and I want to go out and buy Brazilian money, which is why the euro did what they did, because you would do a lot of traveling, right? It's all Europe. It's all they do. It's, here I can drive to Chicago. There they drive from, Amsterdam to Rotterdam to Germany or to Poland or whatever. It's a short ride, but they need different currencies. So instead of having all these currencies, they had the euro, and they said, okay, we got the euro. We don't need to exchange it using the dollar to get each country's currency. That was the thought. But they still need dollar if they go to Switzerland, let's say, and they have euros, then they still need to trade their euros for dollars and then buy the Swiss francs. And again, somebody's holding dollars, and A, it inflates the dollar because there's so many printed, but B, the value of the dollar is dropping. And as the value of the dollar is dropping, all these countries are getting fucked because they spent $1 billion on it and it's worth $500 million. They lost their ass because it's going to take more dollars now. So if I'm in Europe and I'm going to Switzerland, maybe it was $100 to buy, to get $100 was maybe 100, and then that $100 would buy me $100 Swiss franc. Now I need $200 to buy $100 US to then buy my $100 Swiss franc. So you can see if the value of the dollar goes down, there goes this equation, because I had to buy the dollar at X rate and now it's down to Y rate. So it went from 100 to 50, I got fucked. So there's a lot of dollars being printed, which is not good. That's inflationary. And so what BRICS sees and Russia sees is, well, we'll just replace it with a gold-backed currency that won't lose its value. So that's the thing with gold. You got gold, it doesn't lose its value. It doesn't need interest rates, but it won't lose its value because it's an ounce of gold, and you can't print it. So the key with gold and silver, and why do I say to buy that and get out of dollars? Because they print the dollar, right? There's what, $20 trillion plus all these countries outside needing to switch dollars, and get it. Well, they're losing their ass. So there's a lot of dollars outside the U.S. And as you print the dollar, that kills the value. So by going to the gold-backed currency where you can't print gold, the value of that gold-backed currency will remain now, and 5 years from now, it'll still be the same value. And that's the key to it. So that's why you need gold, because they're trying this paper system that doesn't work. It never has, and it never will, because some countries print more than others. It's extremely difficult to say the dollar is equal to the euro. It's just not going to happen because there's more dollars out there, or the British pound, or the Swiss franc, or the yuan or yen, or name the country. They all have their own dollars. So how the fuck do you exchange them, right? I go to Russia, I want rubles, but how do I know what my dollar's worth, and how do I know what theirs is? But if it's gold back, gold's the whole thing, so gold would be worth it. So that's the thing of the gold standard. You can't print it, and obviously everybody's printing the dollars. So this is the problem. The whole world's collapsing because they keep printing and printing and printing, and they're not getting, that makes it worth zero. So the dollars are worth zero, and that's it. And the gold's worth, and the gold's really undervalued because they've been suppressing it. So that's really the key here. You want to have a limited dollar in this medium of exchange. It's got to be scarce. And the dollar and all the dollars, the euros and everything are not scarce, which ruins the whole medium of exchange. So what do we need to trade with? So I go to work, I get paid, I buy things with it. That's the medium of exchange. So it used to be tulips. Apparently it used to be cows way back when. And now it's this dollar, and every country has their own. But so that's the medium of exchange. So we can go to Europe and then switch your dollar to euro, or use your credit card. And you use your credit card, and then there's some FX charges to it. And off you go. So you can still go there as long as you have debit and credit cards. They don't have debit and credit cards as much in Eastern Europe, a little bit in Western Europe. So if they came here, they would use their credit cards, I believe. But you can't print it to nothing, and that's what's happened. So you've killed the medium of exchange. You're not supposed to inflate the medium of exchange. And then you cause the trade cycle. You're causing depressions. You're causing all this. Nobody can pay back their loans. It's a huge credit issue. Look at the government. They owe $35 trillion. Well, they got to pay it. You can't owe it and just say, well, gosh darn it, we won't. We just won't forget about it. No, you've borrowed it. You've got to pay it back. And that's where the problem is. So now how do you pay it? You got to print more money. So even if they wanted to, if they printed $35 trillion to pay for the 35 trillion and say, here you go, the debt's paid off, but you've just killed the value of the dollar, because now there's $50 trillion out there they're not worth anything. So you can't do that. So the debt's killing the country. And that's really what you need to understand. So that's your medium of exchange, but it's not supposed to be printed. And that's the problem it is. So what I guide you to is, okay, all the medium of exchanges in all these countries are fucked. They're printed and printed. It's a bad system. It doesn't work because the rates fluctuate. And the more you print of it, you print because you need money, but the more you print, the less the money's value is. So is it a good medium of exchange? No, it's not. So therefore, the only good medium of exchange is gold. Now you're trying to get into Bitcoin saying, well, I'll make money in it. Fine, but it's not a medium of exchange. It's not money. It's certainly not gold. It's not digital gold. The only thing that is gold is gold. You can't print it. You keep it in your hand. That's why anything valuable like that you want in your hands, not in ETFs or IRAs. So gold is the perfect medium of exchange. It's limited. It's portable. It's scarce. It's divisible. It's fungible. Every day is the same. It's acceptable and it's durable. You can't destroy it. Gold's the perfect medium of exchange, but they don't want it because they can't print it. They can't go to war because they can't print gold. Gold restricts you, even though all you got to do is raise the value of gold. But then if they do that, it makes their medium of exchange worthless. And then they can't govern you, and then they can't fuck us all over. So that's what happens. But what we understand is you fucked up the medium of exchange, aka the Titanic, and the only way out of it is gold. Not you don't want to play these bank and I'll get into that differently, but the banks and the Wall Street control the medium of exchange, and that's really the problem. So if you don't know and you're like, how do I get a safer medium of exchange? What do I do? How do I get out of this? I'm thinking I can see the Titanic hit the iceberg, the water's coming in the boat, I get out of the boat. I go to, oh, there's a lifeboat, I get into that. Now I get off the Titanic, and then as the water fills up, it sinks. So how do I do that here? So they're printing the dollar, so the water's coming in. I know it's going to sink. How do I get into the lifeboat? And the only lifeboat is the gold lifeboat. So you've got to buy the gold because it's the only medium of exchange that works. So they'll play around, but every time they've used these paper medium of exchanges, they've gone to zero. And that's the government not doing their job. It should be very limited, sound money, and it's not. So maybe that makes it easier for you if you understand it's a medium of exchange, so you can get paid, so you can buy goods and services with something, not a cow or a tulip. So we call it money. And then the problem is, though, if you go into too much debt, you've got to make sure you have more money than you have expenses. So then you get into budgeting, which is, if I got $1,000, I can only spend $1,000. But as you can see, the government has $1,000 and spends $5,000. Hence this $35 trillion in debt. That's because you spent more than you have. Therefore, you're killing your currency. So the medium exchange. So you can look at all the other outs. Now, the key to beating inflation is real assets, right? So you can buy a Mantle card, it'll hold its value. And you could buy a Rolex, that'll hold its value, or a Picasso, which you own, not digital. You don't want any digital shit because it's all Ponzi scheme. And so you want to get a Mahomes card or a Mantle card that you have and you hold it. That's what you've got to hold it in your hand. So gold, you need coins. You go to the store, you buy the coin, you buy the bar. Yes, it's somebody you trust, it's legitimate, got it in your safe. I hold the coin. Nobody's going to tell me it's zero. It'll never go to zero because the market is based on demand. And if I have the gold coin, I go to the store, he gives me $2,000 for it. There's demand for my gold. Keep that in mind. So as long as you have gold, there's always demand. There's always a market. But with the medium of exchanges, they're not worth anything. There ends up being no demand for them. Nope, you've printed too many. They're not the word is they're not scarce. You've overabundance them. They've lost their value because you made too many of them. I don't want it. And that's what happens is if there's no demand, there's no market. With no market, there's no value. And that's what's happening. So in clear English, you've printed so much of this that nobody wants it. Now, the problem with these countries are stuck in euro to Swiss franc. I need US dollars. So they realize this. They don't want US dollars, but there's no option. This system's been created where there's no backup system, right? Oh, I got to buy dollars to buy this other currency. Oh, wait, the dollar's worthless. I would prefer to buy other stuff, but there's nothing else out there. That's where gold comes in. I can buy gold. So that's really what gold's role is to be the alternate, the substitute for the dollar. Substitute means, well, I don't want to buy steak's getting too expensive. I'll substitute it with chicken, or Oreo cookies are getting too expensive. I'll get the store brand cookie that's an Oreo, and it's much cheaper. So I don't care. It's too expensive to buy Oreos. So that's what you're doing. So you're substituting the dollar, and the only substitution is gold. You can't use the euro, the Swiss franc, the British pound, because they're all also inflated to zero. So that's really what the problem is. The medium of exchange has no value, and they don't have the substitute in there, which is the gold, which is why BRICS is saying we'll do the substitute. And Russia's saying, well, we're going to back our medium of exchange by gold. And then BRICS is saying, well, we're going to have a BRICS dollar, so all our countries can use the BRICS dollars and as a substitute for the U.S. dollar to get out of the U.S. dollar. So if they want to go to a different country and they need the other currency, they don't need the dollar for it. They'll use this gold-backed BRICS currency. And that's why Russia, China, and every BRICS country central bank is buying gold, and they buy tons of it. So that's what's happening with the medium of exchange getting fucked. So really, that's the bottom line, right? The medium of exchange is fucked. I can't buy. Nobody wants it. And we go to the grocery store and we wonder why Coke's $3.50, because the medium of exchange is dying. It's being printed. There's $35 trillion in debt. They need to pay it. It's to other countries who have bought our T-bills. They need to get paid. So you got to pay China and Russia and India and whoever else is buying your T-bills. As people are stopping because they know they're not going to get paid back, the U.S. is buying from the U.S. So that's the funny part. We have to buy our own bonds because nobody else will buy it. Anyway, so really that's what's happening. The medium of exchange should never be printed as being printed. The money's not sound. The substitute is not the other currencies, it's gold. And then everybody thinks gold, they don't get it. It's a medium of exchange, but it's way undervalued because they've been keeping the price down because they want to keep you in the dollar, because the banks and Wall Street need you in dollar instruments, bonds and stocks and real estate trust and CDs. And that's how they make money, is with the dollar, not with gold. So they'll never put you in gold. So nobody knows. They're all walking around in the dark. Why do I want gold? I can't put it in the stock. I can't use it. Yeah. Okay. Stay in the medium of exchange and see how well that does for you. So as everything collapses, because everything's in the medium of exchange and the medium of exchange goes to zero, the only people that survive are the people with real assets. So you'll be okay in a Mantle card or a Rolex or a Picasso or gold. And since gold is money, you'll use gold to do things. So everything else that's in this medium of exchange of paper, it'll be zero, and your house will be valued at zero because there won't be a dollar anymore, because you've printed the dollar to no value, and then nobody wants it. And then in a market, I can only sell something that people want to buy, and I can't sell the dollar. Nobody wants to buy it. We're this close to it being zero. It's probably zero now, but nobody's waking up. So as people wake up and understand it's not Coke raising its price, it's the dollar being devalued, and it takes more dollars to buy the Coke, the Pepsi, and whatever. Once you realize that, you get the hell out of it. Your 300,000 in the bank that you think you're going to retire on isn't worth anything. And you're going to wake up and go, wait, my medium of exchange of 300,000 that I'm going to spend later in life. What do you mean it's not worth anything? It's worth 300,000. No, they printed it to death because that's the problem. They keep printing this medium of exchange and it's not worth anything. And if you do that, then my savings I can't use later in life because it isn't there. So the only savings you could do is if you take your 300 grand and buy 150 ounces of gold at 2,000 an ounce, that'll always be worth something. That's why you buy the gold, because of the medium of exchange of paper being worthless and the gold always having a value and the gold value going up, because as people start realizing the medium of exchange is worthless, you get the gold. And everybody, that's their only out. You can't buy another medium of exchange, so you buy it. And then the gold price shoots up, and it's being held down by derivative paper gold and JP Morgan, and that goes away because there'll be just too much demand. They won't be able to keep up, and the price will go up because when the BRICS countries want you to buy gold instead of the dollar to buy Argentina dollar to buy Brazil dollar, they'll need it at a higher price. So it goes to 10, 20,000. And then it doesn't go to anything. Then the dollar goes out and then gold has its own value. So gold doesn't need the dollar to have value. What would you do with Bitcoin? It's not a medium of exchange. I got 300,000 Bitcoin. What's it worth? Nothing, because it's priced in dollars and it can't handle being priced by itself because it's not money. And then because it's not acceptable and the value changes. So Bitcoin is an investment like a stock is, but it's not money. It's not a medium of exchange. So you're fucked with Bitcoin. It certainly can't go up. If the dollar goes out, how can Bitcoin go up? It can go to $1 million, but the dollar's not worth anything. So that's the big lesson here is the medium of exchange is not supposed to be printed to nothing. It's not supposed to be used like that. It's supposed to be, I can get paid in it. I can pay my bills and groceries and restaurants, take trips, buy my girlfriend a nice, nice presents, buy my kids nice presents. But that's not, I make 100, I spend less than 100. That's the point of the fiat current of the medium of exchange. It's not supposed to be fiat. It's not supposed to be dollars. It's not supposed to be printed. It's supposed to be sound money, and it's supposed to be scarce. And if you keep printing my medium of exchange, it ain't scarce. It has no value. We're all fucked, which is what they've basically done to us. Now, because I understand this and I've got a master's in this, I'm teaching you what's happening. Now, you either get it or you don't. A lot of people I talk to just don't get it. They don't understand it, that how can the money go to zero? They don't understand it. Well, look at the Romans. How did the Roman Empire fall? Their gold and silver coins didn't have any more gold and silver in them, and it fell. Well, we're the Roman Empire. How can we fall? Well, so if you don't believe, we're America, we can't fall. Well, the Romans said the same thing, I guarantee you. And did the British and did the French and the Spanish and the Amsterdam people, because they had the shipping so they could take their things and sell them and buy things real cheap and then bring them, and keep going out with their shipping. That's why, though, like England and Spain and France and Amsterdam, that's why they were the big hubs, because they had the shipping. Roman Empire basically was it. But they understood money, and when they started inflating, they went out. So keep that in mind. That's the lesson learned. You got to be very careful. But anyway, so that's it for this class. So we've covered the trade cycle, which is basically you're printing too much money, and then instead of letting the market control interest rates, the government's interceding, saying, we're going to lower interest rates. And then we're inflating the money, and we'll get it out there because we believe that if we print money and lower interest rates, people will take it and spend it and grow the economy. but it doesn't work if you fuck up the money. It doesn't work. And that's what they keep trying to do with this whole COVID thing, which was a joke, and everything going on now. It's very close to the end, much quicker than it should be. But they keep suppressing gold, so you don't go into the gold medium of exchange. You stay in the paper medium of exchange because they got you so twisted. You think gold's an investment, like Microsoft. I mean, it's not a stock; it's money, but it's not going to go to zero, which is the key. And then because they're suppressing it, it's not really 2,000 an ounce; it's 10,000. And as the money goes out, the new medium of exchange will be gold, and that'll be priced at 10,000, and then that's what you'll use to go to the grocery store. And there'll be, instead of $5, this is what they used to have: silver certificates, gold certificates. So instead of this will have a gold strip, and this will be worth $5 of gold. But the difference is it'll never lose its value. You'll never have to go through this again once they get to the gold standard. And the governments don't like the gold standard because they can't print it, and they can't fuck everybody over. So it's not the government's role to ruin the medium of exchange, to print the money, and they're all greedy, and then to destroy the country. I don't understand that. And a lot of it is because they're not elected. They're just like Bill Gates and Zuckerberg and Buffet, who happen to stumble into money on stocks and think that they are smart and they're supposed to be the king. And it's like, or George Soros thinks he's a god. These people should just be on an island somewhere and enjoy your money while you have it, not tell everybody what to do. Nobody wants to be told what to do. I try to tell you to get gold and nobody wants to listen. So nobody wants to be told what to do. And that's the bottom line, because Stone Cold says so, right? So that's today's class: trade cycle, medium of exchange, financial powers, the 5 different things of them. Again, it's to have very low taxes, sound money, sound laws, good communication, and free trade is the key to a financial power. We don't have any of those, but that's what, if you do those 5 things, you will have a financial power. And nobody does that now for some reason. Even though it's right there, this is all you need to do, like an NFL team. So anyway, that's what's happening. So I will be back on later with football. My foot's bothering me, so I might swim now, or I might do football a little bit. I'm going to eat. And we've got Mark McGuire, and Mark McGuire's guest today is Alligator. So this should be a good show to listen to with Alligator and Mark McGuire. So that's the only guest I want to listen to on Mark McGuire's show. So I haven't watched it yet. So I will do that, but I have notes from the Andrew McGuire. And I got to be careful with these videos I shot. Apparently I don't have any problems with the finance ones. They don't copyright it, but this one, this Crypto Queen, it's from Germany, I think. And they didn't like that I had it on there. And it was only a minute of showing that she was that, but it might have been because it was a show, like it was a big stage show where they're introducing her and here she is. That might have been why. So I just got to be a little more careful. But I was trying to explain that this Crypto Queen not only stole all your money, $12 billion, but it wasn't even real. So you're buying into one coin, and one coin isn't even real. And it's, again, get rich quick. So please be careful with that. Just ask me. I will tell you all these Ponzi schemes. Everything that's out there is a Ponzi scheme. The only thing that you should be into is gold. Maybe the mantle card that you can make sure. So it's got to be graded. And silver, of course, and then paintings. Go to an auction and get a Picasso for $1 million and make sure it's authenticated. That's it. Okay, fine. Then you're fine. Otherwise, don't buy this. Anything digital is all a Ponzi scheme, and it's all a scam. So please be careful with that. Because it's like somebody's buying this painting $40 million and it's not real. And then he's buying it and the guy's then giving him the money back to make it look like there's something worth 40 million. It's not real. Please be careful. Don't trust anybody. You're too, it's because you don't know. It's like you don't know how to play craps and you're playing craps. And then you're surprised when the 7 kills you. Oops, 7 out. I lost all my money. And you're like, oh, I didn't know that was going to happen. Well, then no play. So I think that's a big problem. All right, we'll get into football shortly. And then I think I'll do the Mark McGuire and then try to watch the Alligator Mark McGuire show today. So www.teaserking.com. I hope this helps. This is a master's level learning series where I'm trying to get right to the point instead of blending it in with football. So have a good day, and I will talk to you very soon. All right. Thank you very much.